So, but Aswath, how do you value the market and companies within the market? Is it more based on what the real economy is telling you and what you expect earnings to be, how you expect them to be affected by this crisis? Or is it more that, capital's got to go somewhere? Interest rates are going to be low for a long time, and thus kind of capital has to flow toward equities. Is that a valuation call?
No, I think the latter argument doesn't really hold up, because in 2008, interest rates dropped, but capital did not flow into equity. It kind of got held in cash. I think the fact that it's flowing back into equity means that at least a subset, and it must be a pretty large subset of the market, believes that not only will the economy come back, but that a subset of companies will actually benefit from the crisis in terms of having higher earnings after the crisis than before the crisis.
So how much of this demand for equities do you think is coming from the retail investor, and maybe the retail investor who's relatively new to this game, if it is a game, and I would argue that it's not? Robinhood often gets the focus here, especially because they're part of this trend of allowing investors to buy fractions of a share of stock, so you don't have to plunk down $1,000+ to get a share of Amazon. Is that really having an effect here, or is that overstated?
I think it's vastly overstated. Collectively, the amount of money that these Robinhood investors are investing cannot make the market change. I think it's an easy excuse for the so-called pros, and I'm going to say so-called pros because there's nothing professional about investing pros and how they approach, many of them approach investing. It's an easy excuse for them saying, look, we were right, they were wrong. It's amazing how when they bet, the pros bet and make money, it's skill. But when Robinhood investors bet and make money, it's speculation. I mean, come on. It's what's sauce for the goose is sauce for the gander.
Professor, I want to get your thoughts more broadly on the market right now in this debate that we've seen playing out in recent weeks around this idea that there's a disconnect between the rally and thus the valuations we've seen in the market and what we're seeing in terms of economic data and just the pain that is playing out in the economy overall.
That disconnect is neither new nor specific to this year. I went back and looked at the last 50 years of data, and there's almost no correlation between what the market does in a quarter and what the economy does in the quarter. The real debate we should be having, and it's a healthy one, is about what the economy will look like a year from now. The market, for better or worse, is expecting the economy to come back pretty strongly. There are people who disagree with that. Let's turn the debate not to what the unemployment claims are right now, but what they will look like a year from now, because that's what the market is predicting.